Okay, so in this video we're going to start to look at the idea of a circular flow of income, and we'll start with a simple idea, then we'll move to the full model, and then we'll look at the idea behind what is known as the multiplier. Really important that you can try and introduce this into any analysis where you are increasing government spending, investment, or even exports, so that you can develop your analysis and also use this as a way of evaluating the effect on the economy. So, very simple model says that you have firms and you have households. And what the households do is they own, the labor and the capital, land and enterprise, and they sell those to the firms in return for an income. So the income comes from the firms and it comes around to the household sector. Now, in return, the firms give goods and services. That's what firms do. They produce goods and services and they sell them to the household sector in return for what we call consumer spending. So income flows around the circular flow. That's why it's a flow of income. And consumer spending goes around back to the firms. Try to avoid, if you can, the use of the term money. I know some people do that, but I think it confuses things later on when you look at money supply in the economy. So it is a flow of income flowing that way and flowing back that way. And basically, if this income flows to the households, then in the very simple model, all they can do is spend that money and it comes around to the firms. But we do know that obviously that's not the full picture, and that the full version is as follows, that the income, which we call in economics Y is for income, not I, because I is reserved for investment. Y for income comes around to the households, and they can do two things with it. In the simple model, they just spend it. Okay. In this model, the full version, they can spend their income and they can withdraw their income. Okay. So consumer spending can come around as it was in the simple version, but also in the full version, you have that out of any income that they get, some is consumed and some is withdrawn. Now, what that means is that the withdrawals can be savings. We use the word S for that. Taxes, that's T, okay, and imports, so M. So withdrawals can be made up of savings, taxes, and imports. Now, just to note, it's an aside really, don't get confused by this. Obviously, it is easier to show it here, so taxes are withdrawn here. Of course, firms pay taxes as well, so that could have another, in the firm sector, you could have taxes coming out, but it's better just to show it in one particular area of the diagram. So the income comes around, some of it gets withdrawn, some of it gets spent. And so the firms have a expenditure. The expenditure on the output of the firms in the UK are made up of consumer spending and J, which is called injections. Now, the injections are made up of investment spending. So that could be one firm buying a machine from another firm. It could be made up of the government sector. The government can be spending money on the firm's output, and the overseas sector, exports, could be spending money on the firm's output as well. So here's the firms producing goods and services, getting money spent on that, those goods and services from the consumers, from investment goods, government spending, and exports. And if you look across here, then the investment and savings is actually the financial sector. What's going on in the financial sector? Some people save their money in banks, and the bank sector comes along and it lends it out to firms who want to do this investment. Government and tax is the public sector. That's the fiscal side of the economy, and the overseas sector, exports and imports. Now, these two don't have to be the same. Okay, so government spending doesn't have to be equal to taxes, as you might know, but in equilibrium, all those injections must equal all those withdrawals, which I'll talk about in a minute. Okay, so here's a typical, I put some numbers on this diagram now. Initial equilibrium, the firms are having spending on their goods and services, £100 million worth of spending, which has come from consumer spending 60 million, there's the C bit, and injections of 40 million. And I've just split down the numbers so that it gives you an idea of the sort of thing that you might be talking about here. Okay. The firms then have £100 million spent on their output. So what do? Well, they have increased the value of output. So you can have output in this circular flow if you want to. But the value of output is 100 million. And then they pass all that spending back to the household sector. And so the income of the household sector is 100 million, which is split between spending 60 million and withdrawing 40 million. So this is equilibrium. This is not going to change as long as the injections that are coming into this circular flow, here they are, equals the withdrawals coming out. Now, the best definition of injections, which you should try and use in exams, is that injections is something that is received by one party, in this case it's the firms, that has not come from the other party. It's come from outside the circular flow. And withdrawals are simply something that has been received by one sector, this case households, which is not passed on to the other sector. That's why I was saying you could have taxes coming out of firms if you wanted to. It's received by, the firms have got it, they've made the profits, and they do not pass it on to the other sector. They withdraw it, they give it to the government. Okay, so what happens though if this is initial equilibrium? What would happen if we increase government spending by, in this case I'm just going to use a simple example of 10 million. And what I've done is in the slightly sort of smaller, here is the old figures that we've just had, and the injections have gone up. As I say, government spending has risen by 10 million. So government spending, which used to be 12, is now 22. So injections used to be 40, is now 50. So expenditure used to be 100, is now 110. So there's an increase on the injection side. What we would say then is that the income of households, which was 100 million, okay, has now gone up to 110 million. And this is the big question, and this is something that you need to be able to explain in an analysis of this, that when the households receive this extra 10 million, they are going to spend some of it and they're going to withdraw some of it. Okay, and those ideas of spending some and withdrawing some is known as the marginal propensity. Marginal means out of every extra pound, how much do they spend, consume, and how much do they withdraw. So in this example, I'm suggesting that with the extra £10 million of income, they basically increase their spending to 65. In other words, they spend half of it. Just to make it simple, they spend half of it, so their spending goes from 60 million to 65 million, and withdrawals go from 40 million up to 45 million. Okay, now I've just put some figures in here, as you can see, that I'm suggesting that it's mainly when they get the extra 10 million, 5 million goes in consumption and savings goes up by 5 million. In other words, they save half of the extra income that they've received. And it's this that has to be explained in your analysis in the exam. Now, I personally would not be drawing an essay in an essay a big circular flow like this, but you can see, I hope, that just here injections is 50 million, withdrawals is only 45. So this is not the end of the story. So what happens now is that instead of 60 million of consumption, it's gone up to 65 million. So consumption now passes around. So in the initial phase, there was an increase in injections. Now we have an increase in consumption part of the expenditure. Now, that means that income is now 115 million. So in other words, the initial increase in income was 100 to 110. Then there's a secondary effect where the income is going up to 115 million. So there's an extra 5 million because consumers spent that 5 million. So again, we ask ourselves, what do we do with this? What does the household do with the extra 5 million? They would basically spend half and withdraw half of that. So this is a simpler way of looking at it. The £100 million equilibrium. Then there's an extra 50 million injections, an extra 10 million, so injections go up to 50 million. Expenditure on the output goes to 110. Therefore, the income is now 110, of which 5 is consumed, 5 is withdrawn. So this extra 65 million here goes in the next time period as extra income and extra expenditure rather of 65 million as opposed to 60. So the expenditure on the firm's output goes up to 115 million. Of course, that then gets passed around as income. So you've got to get over to the examiner in an analysis that expenditure goes up because of injections going up, therefore income goes up, therefore consumption goes up, therefore expenditure goes up. That's the key to your analysis. So with this extra 5 million of income, 2.5 million is consumed again, and so 65 million, 67.5 million now is passed back as extra consumption in the next time period, and on you go. You only need to do it once, you only need to go once around the circular flow when you're explaining this, but hopefully you can see that the 100 million has gone to 110, that's an extra 10, an extra 5, an extra 2.5, and so basically this withdrawals are building up each time it goes around the circular flow until you get to equilibrium again when you get your withdrawals up to 50 million. So that's the way that you need to do your analysis. I'll show you this and how you can use an ADAS diagram. So you would have to say, this is the analysis. Increase in government spending of 10 million means what? It means the expenditure rises as injections rise. Really important. You write these equations out. Injections have gone up by 10 million pounds. Okay? That would therefore shift the aggregate demand curve here by 10 million pounds. In other words, government spending has gone up by 10 million. This is the increase in injections because government spending is part of injections, and so you shift the aggregate demand curve. With our first effect is an increase in the government spending. Then what you would say is that the output of the firms therefore rises. Therefore, incomes rise, so that comes around here, and consumption rises. So the consumption here rises, okay, because of the extra income that has been generated from the extra injections in the first time period. Therefore, this is an increase in consumption. So firstly, it was an increase in injections, now it's an increase in consumption. And you show it on here by saying expenditure rises again, and this is a secondary or multiplier effect, and you show it as a second effect here by shifting out the aggregate demand curve again, but highlighting that it's because of the consumption side. And really that is the initial increase, and the secondary increase is the multiplier effect working through the economy. So that hopefully here, the initial effect of a rise in government spending, then there's a multiplier effect, and you need to explain that, where you get the consumption rising as a secondary effect. So hopefully that's helpful. Another video is going to talk about the numbers behind this and marginal propensities to consume and all of that sort of thing. But for now, analysis of the multiplier effect using a circular flow of income and converting that into an aggregate demand curve. Hopefully that's of help.